If you keep missing your target by 5 pips and then getting stopped out, it's not bad luck. It's lack of momentum confirmation. Welcome to Cheese Talk. No emotions, only structure, risk, and data. Today we're breaking down a momentum trading strategy designed specifically for the 5-minute time frame. It works in Forex and crypto, and it can also be applied to highly liquid stocks for backtesting. The core logic is not about predicting the market. It's about waiting for the market to show that real strength has entered, and then positioning in that direction. We use two tools, the 20-period EMA and MACD. The EMA defines structure. The MACD defines momentum. The exponential moving average reacts faster to recent price action, which makes it ideal for 5-minute charts. And MACD uses the default 12, 26, 9 settings, and we focus on the histogram to confirm momentum shifts. The core principle is straightforward. A price break above or below the moving average is not a signal by itself. Only when momentum confirms does it become actionable. Let's look at a real euro-dollar example. Price was trading below the 20 EMA, and MACD was below 0, showing bearish structure. Price broke above the EMA, but MACD remained negative, so no entry was taken. Minutes later, the MACD histogram crossed above 0. Momentum confirmed. The trade was triggered at 1.2044. The EMA was at 1.2046. Entry was placed 10 pips above at 1.2056. Stop at 1.2026, risking 30 pips. First target at 1.2084. It was hit about 2.5 hours later. Half the position was closed, and the remainder moved to break even. The second half was trailed using 20 EMA minus 15 pips. Final exit at 1.2157. Average gain, 65.5 pips. The key takeaway from this trade is not the profit itself, but the disciplined execution of structure plus momentum confirmation. Now consider a cable short trade. Price broke below the 20 EMA, but MACD was still above the 0 line, so we did not enter immediately. Only after MACD turned negative did we enter at 1.7375, with a stop at 1.7405. Risking 30 pips. The first target at 1.7345 was reached quickly, and the remainder of the position was managed dynamically using the EMA, eventually closing at 1.7268 for a total gain of nearly 70 pips. The advantage of this approach is that it filters out many false breakouts. Simple price crosses often occur in ranging markets, and without momentum backing the move, those breakouts rarely sustain. Of course, this strategy is not invincible. In ranging conditions, price may briefly cross the EMA, while MACD also flips slightly. But without sustained momentum, the move can quickly fail. In one Euro-Swiss trade, price came within just over 10 pips of the target before reversing and hitting the stop loss for a 30-pip loss. These failed setups typically occur during volatility compression phases, which is why it's important to avoid low volatility sessions or use higher time frame trend filters. If you'd like me to fully quantify this strategy, build it into a backtestable model, and publish the win rate, drawdown curve, and cross-market performance results, comment MOMO below. If you focus on Forex, crypto, or short-term trading, subscribe to Cheese Talk.